Good afternoon, ladies and gentlemen. This is Barry Norman on behalf of investing.com, and welcome to our class on beginning or understanding technical analysis. Now, technical analysis is very important for you to understand how the markets move. Learning to get the most out of using technical analysis will help you trade successfully and make smart decisions. Now, technical analysis is the study of market action primarily through the use of charts for the purpose of forecasting future price trends. In its purest form, technical analysis considers only the actual price behavior of the market or instrument based on the premise that price reflects all relevant factors before an investor becomes aware of them through other channels. So in other words, if you're a true technician, you don't pay any attention to the news. You don't look at economic events. You watch price movement on charts. You assume that all that is and will affect the price of an asset is already factored into the price because somebody is already watching the news. Somebody's already taking it into account for those economic events. So that's already moved or factored into the price. Technician doesn't really care what the reason was that moved the market. He wants to see why the market moved, how it moved, and he wants to understand the psychology around the movement because technicians believe that there are patterns repeated in price movement based on the psychological makeup of buyers and sellers. And even though it sounds like it's not really a science or a study when you explain it that way, it really is. And technical analysis is based on 3 assumptions. And these assumptions are as far from scientific as you can get. But they are very important, and they form the crux of all technical analysis. Number 1 is that history tends to repeat itself. And this is more about price movement in patterns that develop in price. Technicians believe that the market psychology will repeat itself. So when you see the markets reacting in a particular way now, and you can see how it reacted in that same fashion 2 years ago, that you can predict how the markets will move forward because the psychological makeup of the bulls and the bears, the buyers and the sellers remain pretty much the same. They also believe that price moves in trends, in uptrends and then downtrends, and predictable movement. The price will move up as the bulls dominate the market, and then when they wear out, the bears will take control of it. There's entire trading strategies based on the movement of trends. Elliott waves and swing trading are all based on this psychology. But if you're new to the markets and haven't heard it yet, the saying that the trend is your friend is very important. Now, technical analysis is widely used among traders and financial professionals. In fact, most of the black box systems that you hear out there, most of the robotic trading and the computerized trading are all based on technical analysis because they believe that by removing the emotion from the markets, you can better analyze what is going to happen. Now, some studies say it's more widespread than fundamental analysis in the financial markets. Now, fundamental analysis is what most beginning traders rely on because it's things you can readily understand. Jobs reports, speeches, elections, economic events, geopolitical conflicts. So it's easy to predict price movement based on these events. So most beginning traders start out from that. But most professional traders either are technicians or combine technical analysis into their fundamental analysis. Now, technical analysis is a methodology that makes buy and sell decisions using market statistics. It primarily involves studying charts showing how trading history and statistics of whatever security is being analyzed. So technical analysis holds true and works the same whether you're trading commodities or currencies, stocks or indices, or you're a rice trader. To perform technical analysis, investors start with charts that show the price and the trading volume history of a particular security or index, as well as hosts of other statistical measures such as moving averages, maximums and minimums, and percent changes. The idea is to use charts to identify trends and changes in those trends. There are several kinds of trends and patterns, some with unusual names, and once you start trading, you'll hear them all. Rectangles, triangles, Bollinger Bands, inverted head and shoulders, candlesticks, MACD histograms, stochastics, and so forth. Some technical analysis also use indicators and oscillators to interpret trading data. So the question is, where do we start? Technical analysis can be as complex or as simple as you want it to be, but it all starts on the same basis. It starts out by being able to read a chart. So building your roadmap to success, you need to start off with the proper foundation, and that is how to understand what a chart is and how charts work. So unlike fundamental analysis, which focuses on finding the security's true value, by studying financial statements, market outlooks, competition, macroeconomics, technical analysis is based on the belief that past market trends can predict the future behavior of markets as well as the whole or even individual stocks. If an investor can correctly interpret a chart's message and predict a security's movement, he or she can obviously make a lot of money. Certain aspects of technical analysis are controversial, such as the belief that markets move in trends that can play out over very long periods of time, and the contention that market action can detect shifts in supply and demand relationships. Now, there are many reasons that you should use technical analysis, even if you don't fully believe in it. One of the hardest ways, or one of the most fervent reasons I can give you for using technical analysis, is it might point out some mistake you've made with the technical analysis. If you think because Donald Trump won the election, the dollar should go down and the dollar goes up, possibly if you've been looking for something in the charts, it might have forewarned you that your assumption was wrong. Now, technical analysis believes that investors en masse display much of the same behavior as the investors that preceded them. Everyone wants to be in on Microsoft. If the stock ever gets to $50 again, I will buy it. The company's technology will revolutionize its industry. Therefore, the stock will skyrocket. These are all examples of investors' attitudes repeating. To a technical analysis, the human characteristic of the market might be irrational, but nonetheless they exist because investors' attitudes often repeat. Investors' actions in the marketplace often repeat, as well as patterns and price movements will develop on a chart that a technical analyst believes have predictive qualities. Not at the price, but the pattern. When you start seeing a price move up and you start seeing it move in the same pattern, means the psychology of the markets is the same as it was a year ago, even though that price was very, very much lower or much more different. But when the bulls and the bears are reacting in the same way, you can then use that to predict how the psychology will affect the markets today. More or less, things could repeat themselves through cycles over and over. You watch the housing market, the job market. We know when the job market crashed in 2006 or 2008 and the housing market, we knew it would come back, and now it's going to actually come back. The prices are coming back to where they were before the crash. People have, and the markets will then start to do almost the same thing. The psychology because the greed and the fear in people doesn't change. Now, I'm a firm believer that a lot of people try to look at patterns that happened many years ago. I firmly believe that it does tell us the psychology of the markets, but that the psychology of the people in the markets changes because the makeup of the market changes. So in other words, when I started trading back in the 1970s, we were all basically day traders. We would sit in a broker's office, watch the ticker tape and there was only a handful, and the markets moved very slow. Then in the 80s and the 90s, when retail investing started and we started to get these low commission accounts and we started to get more and more different people into the marketplace, and then with the beginning of the 2000s, with all this new retail online traffic, the people that make up the market has changed. 10 years ago, we didn't have evening investors. We didn't have investors that were trying to do this as an extra bonus. We didn't have binary options. We didn't have CFDs. Forex was just starting. We didn't have leverage and margin. So what's happened is the makeup of the market has changed, and therefore the people have changed and the psychology of the markets have changed. So it's very important when you start reading or learning about technical analysis. A lot of people try to convince you that if you saw a pattern in 1985 and it repeated again in 1996, and you start seeing the same thing develop now, that it's going to have the same action. Most likely they are wrong, because you guys listening to me are much different than what I was 35 or 40 years ago, because we didn't have computers to learn from. We learned by studying. We wrote charts by hand. It took hours. Today, you can learn how to use a chart in no time flat, and a chart will put everything you need on there. You don't have to learn the calculations of what RSI is or what MACD is. You don't have to sit there and actually know the mathematics and actually be putting it on your charts. The markets moved a lot slower in those days. We didn't have internet, so we couldn't get the news as fast. It was hard to get data. I mean, mostly we had ticker tapes and fax machines. So all this has changed. So it's important to understand that the realm of technical analysis is not limited to charting. Technical analysis is always the primary concern with price trends. Anything that can influence the price is of interest to the technical analysis. As an example, many technical analysis monitor surveys of investors' enthusiasm. These surveys attempt to gauge the general attitude of the investment community to determine whether investors are bearish or bullish. But again, this is a mathematical calculation and a monitor that is then dropped on a chart. It is not an economic event. Okay, it is not a speech. Okay, technical analysis uses these surveys to determine whether trends will reverse or whether new trends will develop. Because if you see volume changing and you see more bears or more bulls entering the marketplace, you know which direction you pull. So we want to be aware of what their attitude is. Okay. A technical analysis would be alerted that a trend might change when these survey reports report extreme investor reactions. When surveys are overly bullish, for example, a technical analyst will look for evidence that an uptrend will reverse. This is called being overbought or oversold in the market. And these are mathematical calculations that are placed below a chart. And depending on what the calculation is, it will tell you simply whether the markets are overbought and oversold. Doesn't mean they're going to reverse. It just means they have a tendency so. The logic being that if most investors are bullish, then they would have already bought into the market. Okay, because most investors are bullish and have invested, it's safe to assume that there are few buyers remaining on the sidelines. So all of this comes from technical analysis. Now, whether technical analysis is really useful is a matter of some dispute. Some investors believe that it is impossible to forecast a market's ups and downs. Economic studies have shown that when most people, professionals and amateurs alike, try to move money in and out of stocks to beat market fluctuation, they tend to wind up with losses. Some academic studies say technical analysis has little predictive power, but other studies say it may produce excess returns. For example, a measurable form of technical analysis, such as a nonlinear prediction using neural networks, have been shown to occasionally produce statistical significant predicting results. Now, it really is only, if you understand, is a tool. And ultimately, it's why robots and black boxes are not ultimately successful without a human nature, because the human being is the one that can then take all of this data in and use their gut. And unfortunately, your gut or your luck is always going to have a deciding factor. It's an uncalculated investment, an uncalculated part of trading. In 1982, 83, and 84, I couldn't make a trade that went bad. As long as I used the strategy I developed, made the trade, followed my rules, everything went perfect. By 1985, I was using those same rules, and I couldn't make one good trade. By 1986, I had lost everything I made in 82, 83, and 84. Now, why? Well, markets change, but also your luck changes. And when you start a run of successes, you get a little bit more, I don't know the word, you get a little bit more aggressive. You get a little bit more confident. When you start having a few losses, you start questioning yourself. And even though your rules change, or your rules don't change and they keep you on course, that little bit of luck can have a difference. That little bit of feeling in your soul. And this is one of the reasons I tell all new traders, master a couple assets. Know their personality. Like I was only an agricultural trader. I only traded agriculture. That was it. Very, very limited. Okay? Because I would know everything and anything, and you had the ability to feel a trade. Okay? Now, there are 3 parts of beginning to put information on a chart that help technical analysis. And this is the trends, support, and resistance. And these are firm things that we need no matter what trading system you're doing. Even if you're trading with fundamental analysis and you're not even really involved in charts, by understanding support and resistance and trends, at least you can then, when you've decided using your fundamental analysis tools to trade an asset going up, don't you want to know when that asset is moving up, where it should have a reaction, where it might fall, where it might not go through, or if it reverses against you, at what point should you be exiting the market, or is just a breather? And this you're only going to get from technical analysis, from prices and charts. And these come from trends and support and resistance. It just simply lets you know at what price levels you might expect a response. Now, most investors tend to be either technicians or fundamental investors, though many believe in combining technical and fundamental analysis is the best way to evaluate exit and entry points. Since many people believe in technical trading rules, at the very least, the rules can become self-fulfilling, making them important to know for the individual investor. Now, imagine you have a chart. You've put the correct trend line on there following the rules. You've put the correct levels of support and resistance. So you now expecting the euro to react at 108.71. You're expecting, you don't know whether it's going to go above it or below, but you're expecting some type of reaction to at that price level because everything has come together there. Okay? So you can't predict which way it's going to go. But when you can predict a price level, or you can formulate a price level where the market should have some reaction, and the fact is the million other traders trading that euro at that time also have that same price on their charts, and they're going to react. Well, when you see what their reaction is, you can then make a smart decision. Or if you expect some reaction at the euro at 108.71 and you're in the euro going up, where would you might set your take profit point? Because you can always come back into the market. So where would I set my take profit? I tell my trade to close at 108.71. Because if it's going to bounce off and fall below, I'll lock in my profit. If it does bounce off and fall below, I can re-enter the market if I believe it's going to continue back up after that. Or if it breaks above and I was wrong, I still locked in my profit, got it in my account, I can re-enter the market when it breaks above to continue going up. Okay, because you can enter and exit the market all you want. If you say, okay, we know 108.71 is an important number in this uptrend, and we see a break the 108.71, we might decide to enter the market to go up to the next level that we decided is important. Okay? Or you can continually move your stop loss, it's called a trailing stop loss, to keep locking in your profit. But before you could do any of this is you have to start out with your charts. And charts are a roadmap to your success. They are the beginning of where you start. So technical analysis basically is all wrapped around charts. Now charts come in 3 different styles. Okay. Now there's a zillion different kinds of charts out there. Today with computers, all these people are coming up, but they still fall in these 3 main categories. And these are called bar charts, line charts, and candlestick charts. Okay. All the other variations are variations of these 3. Okay. Now, the fact is, the more detailed information you put on your chart, the more likely you're not going to get lost. So if you remember right, before we had GPS, we had maps. And before I'd go to a meeting that was, across town, I'd find out how I'd have to get there. Now, I was pretty lazy. Okay, somebody say, okay, we're over off of the, the Beltway on exit number 7. I would know that, but I wouldn't go any farther. Where I had friends that carried atlases in their car, and they could tell you not only this, get off in this lane, get onto that lane, get off when you see the filling station, go 2 more blocks till you see the church, turn right at the church, go to the 3rd stoplight, and pull in the parking lot, because they could read their maps. Now, I spent a lot of time pulling off into gas stations asking for directions. Spent a lot of time getting lost. My business partner those days never got lost, ever. So I was the driver and he was the guide. And we always got where we're going because he could read the maps in detail. Now, when we start looking at our charts, we start off with the bare basics. And this is called a line chart. It really doesn't help us much of anything. A line chart is a simple dot put on a chart at the close of a time period based on the time frame you're looking at. So right now we're looking at the euro-US dollar in a 30-minute time frame, which means every 30 minutes we put a dot on this price on the chart at the price that the euro-US dollar was trading at. And we connect those dots together and we have the price movement. Okay, it gives us a general look at how price is moving, but no detail. We can see nothing except the euro was falling in this chart. Okay. We can't tell if it was a steady decline. We can't tell if it's been bouncing up and down and just where it closed, but we can get some general information. Not anything I would risk my money on. Now from here we come to a bar chart, which is by most professional traders their best and favorite chart. Okay. And as you see, this is a bar chart for the same time frame and the same asset we looked at on the line chart. Okay, so this is the line chart. When we put it as a bar chart, all of a sudden we can see a lot more information. We can very easily visually see how the price has been moving. We can actually see common prices. We can see trend lines. We can look at almost, without putting a line on the chart, see predictions. Look at how important this trend line is right here in this downtrend. Look at how important this price is for this asset when we see all these opens and closes and these tops and bottoms at the same price. Okay. Look at how strong this uptrend is, but we can see common price. Look when we do the downtrend here. We can actually put this downtrend line on here and see a price that's been strategically important all the way down. Now, in a bar chart, and this is called a bar because each time frame has a bar on it. Okay. Each one of these represents the same 30-minute segment, okay, or whatever time frame you've decided to use for your charts. And this tells us a whole entire story of how price moved in that 30-minute period in an easy to see visual image. What we see is the top, the high, the bottom of the close, the open, and the low in each one of these bars. So we see everything that happened in that 30-minute period. So sometimes these are referred to as an OHLC, open, high, low, and close. And what we do is every 30 minutes, or whatever time frame we've decided, and we'll talk about time frames in a little bit, is we put a bar or a doohickey to the left at the open. So at the beginning of that 30-minute period, wherever that price is and it opens, that's where we put this little doohickey. Okay. At the close of that 30 minutes, we put another doohickey to the opposite direction. So we put a dash to the right. We then put a dot on the top of the highest price that asset touched in that 30-minute time frame, and we put a dot at the lowest price. We then connect them together with a line. So what do we have? We have open, high, low, and close, and we have a bullish signal. Why is it bullish? Who controlled the markets during that 30-minute segment or that time segment? It's bullish because what happened was we stepped up the ladder from the open to the close. So at the end of that 30-minute segment, the bulls had control of the marketplace. They opened here and they controlled the market. Sure, the market pushed up higher and pushed down lower because the market still trade, but predominantly the bulls had control of the ball in that segment. Now, conversely, if the open was here and we put the dash for the close here and we saw we stepped down the ladder, that tells us the bears were in control of the market. Now, understanding who's controlling the market at the moment is critically important to trading. Okay, it is less so important than the price, because who's in control makes up the psychology of the markets. And it also lets us see what prices are common. Where do these prices see actions and reactions? Okay. From here, we can move on to one of the oldest styles of charting, which is called candlesticks. Now, with the development of online trading and Forex trade or retail trading, we have seen this huge jump in traders wanting to use Japanese candlesticks. Now, the fact is they've been around since the 1700s. And Japanese candlesticks have the same information that a bar chart have, except they're kind of pretty to look at, and too many traders make assumptions based on the colors of which way price is moving. And if you notice, I said assumption. And what's the old saying about assumption? It makes an ass out of you and me. Now, Japanese candlesticks have very little to do with the colors you see. Now, this is the same price movement, same chart as we saw for the bar chart. With the Japanese candlestick, we do the same process, except we color in the red color in this case, or whatever is the bearish color, when it was a step down the ladder. When it's a step up the ladder, we color it in with the bullish or whatever we consider the strong colors. We are human beings, and human beings tend to act and react based on these colors. But the colors are not what Japanese candlesticks are about. There are actually 32 different interpretations of the candles based on the wicks, okay, and the length and the shape of the body and what one body looks like next to the other body. And there are 32 different variations, and they go from all kinds of odd names. We have the hangman, the inverted hangman. We have the marabusu. We have the all kinds of things out there. We have evening stars, morning stars, 3 crows, 3 soldiers. And all of these depict the relationship in price from one to the next. And without learning these, okay, and devoting the time, you're then falsely using the candlestick chart. And you're making assumptions based on your lack of knowledge instead of your knowledge. So I advise all traders to stick with bar charts. But the nice new charts, the new HTML and Java charts, allow you to just click a button and move it from candlesticks to bar chart. So it doesn't really make much of a difference. But if you notice, to draw a candlestick chart, we put a line across at the open, a line across at the close, a dot at the high, and a dot at the low, and we connect the wicks to the candles. So what is it? O, H, L, C, step up, bullish, step down, bearish. Okay? So it's just like a bar chart, except you have the bodies. Now, once you have the bodies, unless you know how to properly read those bodies, you're making a mistake. If you learn how to use the bodies, then you will be much more successful, and it will give you a great understanding of the markets. And we have a 3-week course in understanding Japanese candlesticks. So if you want to trade with them, come to our course and at least get yourself a grip on what all of these patterns are and what they should be. Now, it's your choice. Forex trading attracts many different types of traders with many different types of systems. If you want to trade a currency pair, it's best to become as familiar with it as possible. If you want to trade a stock, it's best to know it inside and out. If you want to trade gold or oil, it's best to be an expert on gold and oil. Viewing a currency pair in multiple time frames is part of the process of viewing its personality. Understanding the currency pair's personality can help you in your success of trading. So today, again, because of the ease of charting, you can look at the euro-US dollar in a 15-minute time frame, a 30-minute time frame, and a 1-hour time frame and compare them. Now, what's the difference? The price still moves exactly the same. Okay. But you can then see what prices or how weak or strong the bulls were in every 15 minutes instead of every 30 minutes. That's simply the difference. You can see more definitively how price is moving in the most current segment. And it will also give you some comparisons that you might give you better interpretations of the market. Now, one of the best reasons to learn how to read a chart properly is so that you can apply technical analysis. Not every trader believes in using technical analysis, but it can be useful. Even if it's not your primary method of trading, technical analysis relies on price that is on the chart you are using. So the more and more information you add to your charts, the more successful you will be. So no different than the maps from my old days. When I would use my little sketch of a map, or remember even today, you get an invitation to a wedding, and on the back of it, you'll usually get some little sketch, a couple lines that'll get you off the highway into the parking lot, show you where to park and what building to enter. Okay. Now, it's not detailed, but it helps you along the way. Now, the more information you put on these charts, like I said, my business partner could read them in great detail, and we would never get lost going anywhere. Now, we're looking at a roadmap from London, or the London and surrounding areas. From here, we're going to go over to a complicated chart, okay? And doesn't it look almost the same? The same lines, the same width, the same all this stuff, the same mumbo jumbo that confuses the hell out of you. But if you learn to read it successfully, you won't get lost. And you can make them as easy or basic as you want, or as clean. And the thing you'll find is once they're your lines that you put on a chart, and you put them the colors you want, you put them the width you want, you put them where you want, you'll know what they are. You'll understand them. You'll understand what they represent. Okay. Like for instance, in this chart, which isn't one of my charts, it's just one that I put on here, they use purple to show support and resistance lines. I would never use these purple or these violet dash lines. I use reds and greens for tops and bottoms. I use blues and golds, okay, because these are my trading systems. I don't use, so you can eventually learn to read somebody else's, but you'll find when it's your own chart, you will not have a problem. Now, somebody said my chart is not showing. If you're not seeing it on your computer, it means you need to reboot your computer or click on refresh because it's not on my side, it's on your side. Now, there are numerous types of patterns that we can see developing in charts. Okay. And these are price movements. And these movements on a chart tell you something. And they're not very complicated. We have, first of all, what's called triangles. Triangles are the movement of price in a chart based on a support line and a trend line. Now, what happens is, basically, if you understand the psychology of the markets, is when we see these prices fitting into this triangle, what it's telling us is the price and the bulls and the bears are pulling in, and they're getting to the point when they reach the peak of the triangle that they're going to burst out. When they burst out, once they form the triangle and they burst out, the markets are going to continue in the direction or have momentum to move in the direction that they burst out. What it's basically telling us, who controlled? You had this tug of war going on between the bears and the bulls, the bears and the bulls. The bulls pulled across the river one way, the bulls pulled back, the bears pulled the other way. The bull, how far they moved in each direction, who was succeeding, we see along the way. But sooner or later, those bears get tired out. Now, when that battle gets fairly even and they start fitting into that center corner piece, sooner or later, one of the two sides either going to have a new player join them, they're going to have new momentum, whatever it is, they're going to be able to pull. When they pull and they break out of that pattern, they will have strength in that direction. So these are called triangles, and you can see these easily on charts. Now we have a whole course coming up in chat patterns and charts. Okay. We also have what's called channels and rectangles. Again, it's simply putting lines on charts that give you some understanding. Okay. We even have wedges. Wedges are slightly different than triangles, but they're fairly much like triangles. But they're all telling you the story of the bulls and the bears and the market psychology. Then we come to my favorite and one of the most tradable patterns. You'll hear it all your entire life once you're a trader, and that's the head and shoulders. Sounds funny, but it works, and it always works. It is the most, when it appears, it is one of the most reliable patterns you can get. And it means that price moved up above what's called the resistance line. It came back down, and that resistance line supported it. This formed the first shoulder. Now, when it's just forming, you don't know that yet. Then it pushed up and came to a new peak and came back down to what we call the neckline, which is the same level here and here. Well, when you have a difference between the peaks and it forms a head, okay, now we still don't see it yet. We bounce back off of that same neckline and we form another peak and we start coming back down. What do we have? We have the head and the shoulders. And when these align within statisticals and it's within 10%, it then tells us something. And what it tells us is that the asset will then break down, and we can also, there's also a formula that you can apply to the degree of the movement to predict where it's going to, where your target price will be going down. And it works 99% of the time. Okay. Now, you have to be learned to identify this formation and when it happens, and you have to know how to apply it. And that's why we have classes in this, but it works. And it works regularly. It's worked historically. Okay. Now, the popular head and shoulder pattern is essentially a triple top pattern, except that instead of the peaks hitting the same resistance level, the peaks slightly higher than the shoulders. Okay. Now, we also have triple tops and triple bottoms. And well, that's when price moved up, hit a certain price, fell back off of, fell down to a same level, moved back up, hit it again, came back down, and then hit it again. What does it tell you about that price? So imagine a stock was trading at $32.50, and every time it went up to $33, it couldn't get there. It would hit it and fall back down to $32.50. The next time it would go up from $32.50, get to $33 again, and couldn't get through. Go back down to $32.25. We don't care where it went down to. The next time it moved up to 32, started moving up towards that 32, above 32.50, would you think it would be able to break $33? Statistically, no. So $33 becomes a crucial number. Now, you could have bought that stock at $32.50 to sell it at 33. Or when it hit 33, you could decide to enter the market, to sell the market down because it'll most likely go down if it isn't able to break through. So this starts giving you some critical ways to make decisions. And all of this is based on what's called trend lines. Trend lines are the rule of the markets. The trend is your friend. And trend lines are the first piece of information that you would put on a chart. And a trend line requires you to connect at least two or more common prices and to draw a line through those prices. Now, too many beginning traders say, I can put trend lines on the chart all the time. I can always find prices in common. But the fact is, trend lines have very specific rules and guidelines because you want to draw your trend line just like the other million traders around the world, because you need to know what price is important to the markets and what price is important to the psychology of the markets. And therefore, you start out with the first line you put on your chart, setting up the entire market. And trend lines are one of the most powerful concepts of day trading or long-term investing, and they are one of the most powerful concepts. Trend lines have been used for trading as long as there have been markets, and they are well suited for any type of market, stocks, currencies, commodities, futures. Trend lines are based on the idea that markets move in trends, sustained movement in one direction, and then sustained movement in the opposite. Trend lines show the general direction of the price movement and the strength of the current price movement and where future support and resistance are likely to be located. Trend lines show three distinct pieces of information, but related pieces of information about the market. They show direction of the current price movement, the strength, and that's based on more precisely the speed, the depth of the trend, and where you can expect price to act and react. Now, drawing a trend line is very important. So even if you're going to be a fundamental trader, you need to know how to read a chart and how to put the first piece of information on it, and that's a trend, so that you can actually use it to help your fundamental decisions. Now, it's possible to draw trend lines between any points on a chart, and they often look pretty good. In fact, one of the issues I've had working with newer traders is that they will say to me, I drew this line and I like it. I can draw a line. I can draw any line I want. Yes, of course you can, but the question is, and this is what's ultimately important, is how you draw your line, that is, how do you draw a line that is meaningful with the respect that will respect the volatility and the integrity of whatever the trend might be in effect. So we also have a whole 1-hour class called The Trend is Your Friend, and we'll teach you in detail all of these rules. But the correct way of drawing a trend line is to find what's called the swing lows and put 2 points in common and wait. You need a third point, but you can draw it with 2, and then you're waiting for that trend to be validated by it hitting the third. Now, a lot of times these trends aren't so close to prices that you want, too many traders would want to draw a trend line here and neglect this little downtrend, this little breakthrough here. And what happens is when you do that, your trend line is no longer accurate. So when the price came down here to where this trend line is, that price wasn't a price that the markets were interested in. In your trend line it was, but the fact is this is the trend line that the markets were looking at. So they were looking for some reaction at this level, not at that level. So you have to learn to follow the rules, okay, so that you can understand all of this. A rule-based trend line is one that starts and stops according to well-defined conditions, such as lines starting at the lowest price the last 3 days and ending at the highest price. A rule-based trend line is better than an impressionistic trend line for 3 reasons. It doesn't let you impose your personal view on what the trend should be. It improves your ability and self-confidence to buy a security when its price is rising or selling when the price is falling. It helps prevent loss by showing you exit at the right time. Okay. So a trend line is crucially important to help see market reversals or when the market is about to change. You might have noticed that trading with a trend is more powerful than trading counter a trend, and hence the adage of the markets, the trend is your friend. as a whole, counter trend trades are less profitable trades. So you will take more skill and experience and precision. If you trade with the trend, you will end up making more pips and have more successful trade. So an experienced trader doesn't trade against the trend. They look to buy into strong up movements and sell into down movements. Okay? Because statistically, you will make more profit in those trades. So what you're looking for is to learn some type of understanding about the market, some type of system, rules, some type of guide that will help you understand what price is doing. Again, you can use fundamental analysis. So when you said, when Janet Yellen raised interest rates, we knew the dollar was going to go up and gold was going to go down. But how far was the dollar going to go? How could I monitor that dollar when I'm trading it? Or if I was trading gold to go down, how do I know how far it's going to go? How do I know where to put my stop loss and my take profit book? How do I know when to exit the market? How do I know when it's getting ready to make a shift? And that comes from technical analysis. And therefore, we finished our general guide to technical analysis tonight at our beginning. And if you go to investing.com and look at the schedule, you see we have lots of classes that will help you break down this study of technical, and you can learn little bits at a time. Come to our class. At the end of the month, we have a 1-hour class. It's just basic charts. We're just going to teach you how to read and set up your charts, how to use all the computerized charts, how to drop the indicators properly on your charts. But we have 20 classes this month. Come to them and learn how to use technical analysis. So thank you very much and have a great day. And thank you for being part of investing.com. Bye now.